To trade the news, you could trade it before the result actually happens. You would have to use the forecast and get an understanding of what the consensus of the market is. Or you can trade the news as it happens. So you see the result and you react off that, or you react in what your view of what the consensus of the market are thinking. And there's a few different ways you can actually trade, the actual process of trading, I mean. You could either buy or sell if you think the price is going to go up or down, and you could do that on a short-term contract, or you could do it on a longer-term contract, which is what we call a forward contract. So you actually book a date that you want to hold the trade until, or if you're taking the short-term contract, which is commonly known as a spot contract, brokers will roll your trade every day, and you may have to pay a fee for that. Now, when you open the trade, it's a good idea to place a stop loss and a take profit order, and to assess these levels. How much do you want to risk, and how much do you potentially want to make? So you can position yourself like this. You can position yourself either where you buy to go long, or you can position yourself where you sell to go short, and it's just simple trend trading. There is also another way to trade these big announcements, because often when you get a big announcement, you either get a big move up or down just before, or if the announcement is unexpected, after the result. So there's another contract called an options contract, which allows you to reserve a rate in the market instead, and you pay a fee to reserve. So you don't have to use a stop loss when you're buying options, because instead you're just paying this fee, and that fee is your maximum risk. So even if the price went 100% against you, it doesn't matter. The fee is the most amount you can lose. But on the other side, you can, if you are correct, you can make an unlimited profit. So it behaves in a similar way to a regular spot or forward contract. I mean, I think it's completely fine to trade before an announcement, maybe not seconds or minutes before, but in the hours before or the days before an announcement. It's completely fine to trade, and it's actually a strategy that a lot of people do. What a lot of the market is doing, they're factoring in what the forecast of an announcement is, and so they're trading it before. So why not follow the consensus and also trade it before? But if you're talking about trading an announcement a few seconds beforehand, that could be a little trickier because of the volatility, and the move of the expected result has already happened, and you don't have the actual result yet. So what is there to trade? If you're in regular trading where you just want to follow a direction either up or down, there's nothing you can really trade, I guess, accurately a few seconds before an announcement. But what you can trade is an increase in volatility. If you expect that volatility is going to hugely increase, then you could put on a trade that allows you to trade an increase in volatility. And that's where options comes into play, because with options you can trade direction, or you can trade volatility, or you can trade both. So the only trade that you could really put on minutes before, or closer to the time, if you expect an increase in volatility, is through buying options. Employment data is obviously a very important indicator of how economy is doing. So yes, this is one of the important bits of data that you have to keep an eye on. And especially for the United States. I mean, there's something called the non-farm payrolls, which gives you a number on how many people have been employed apart from the farming payroll in the United States. And it's a highly watched figure. Not just in the US, any trader that's interested in any US dollar pair, it can also affect gold price, it can affect oil price, will be watching that NFP result, which is the first Friday of every month. And it traditionally, because so many people are interested in it, and the US dollar is still regarded as one of the most important currencies around the world. I mean, there's a lot of other currencies pegged to the US dollar. So it does have this attachment, and on an NFP release, you will often see huge spikes in volatility. and not necessarily related to direction, because when the market are unsure and they're not sure about what the result is going to be, and it's so important, it creates a very jittery market. So you could see, it would be no surprise to see on an NFP sterling US dollar moving up 100 pips and then falling 100 pips and then falling another 100 pips. And so it can be a great opportunity if you get it right. But if you don't know where to place your stop loss order and you don't know what risk you're taking, then it could be a potentially disastrous trade to take. Like for example, let's say you expect a good NFP result. So US dollar, say, is going to strengthen. And you've put a trade on that. So let's say you've sold sterling to US dollar, you've sold sterling and you've bought the US dollar, which means you expect sterling dollar to fall because the US dollar is going to get stronger. Okay. Now, and you place your stop loss order 100 pips above that. So sterling dollar, let's say, is trading at 150. You expect it to move to 149 on the result, but you place your stop loss at 151. Just an example. You could be completely right. The NFP result comes down, and ultimately it doesn't move to 149. In fact, it moves to 148 because you've got the right result. But before it got to 149, it actually just jumped up 100 pips to 151. So you haven't taken advantage of your right prediction at all, because you're out of the trade, because volatility has knocked you out. The stop loss has knocked you out of the trade. So your actual theory on what was going to happen was correct, but you haven't paid attention to where you're going to place your stop loss order. And this is why it's so important to consider volatility as well. Now, if you were to instead trade that with an option contract, so an option, you could reserve a price, you could reserve the 150 price to sell. So it's the same concept. You expect sterling dollar to go down and you pay a fee. There's no stop loss. So even if it moves up 100 pips before it falls 200 pips, you're still in the trade, you're not knocked out, and you can profit from that scenario. So that's why buying an option may be beneficial over large volatile data announcements to trading in the underlying market, so trading a spot or forward contract.
It's interesting because, I mean, where can you get, how do you make an educated assessment of belief that, the figures are going to improve? I mean, how do you do that? Or is that where it becomes almost a gamble? You just think, I've not heard any bad news over the last 3 months, there's, I don't know, Lockheed have just put in an order for another 1,000 jets, so, things are still looking good. But if you don't, if there's nothing going on, how do you make that guess? Or is that purely a guess?
Yeah, so it is an assessment of previous data results. If you've seen, there's lots of other results that are geared towards how an economy is doing. What's happening most of the time is people are trading what they expect the result to be. So that's where you see the move going, and then when there's an announcement, it can be a surprise. But yes, if you've been following the data releases and you have an idea and you believe that the NFP result is going to be worse or better than the forecast, then you can place a trade on it. But yeah, it's really, you have to use the information that you have, and you can make an educated guess based on that. But most of the time, traders, the consensus is before the result, traders are trading the forecast.